Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as you know, I'm always looking for high quality businesses to add to the portfolio, and in this video today I'm going to talk about one company that I really like. They've reported their earnings a couple of days ago. They went down about almost 9% when they reported. I want to see if it is, right now a good time to add to the portfolio or not. I will share with you guys what the business does. I'll let you know what I'm going to do at the end, and we'll do the quick valuation. We'll talk about the financials, and then we'll talk about, at the end of the video, I'll tell you exactly what I'm going to do, inshallah, moving forward. And as you can see here, this is my entire portfolio. Don't be alarmed because I've just made a sale, and basically there's £5,000 sitting there. I've sold one stock, so I will be putting that money to work, inshallah, from Monday onwards. So I will let you know. But yeah, let's talk about the company that we came here for, and that is Applied Materials. Applied Materials have not done well at all, especially the semiconductor equipment companies. So we're talking about KLA, Lam Research, and this company have not actually done much as in comparison to the rest of the semiconductor companies. So these are equipment guys, and they haven't done really well. Year to date is about 4% up. If we compare that, for example, with basically Broadcom, for example, AFGL, you will see basically this company has done like almost a 50% up. And if we look at Lam Research, for example, will probably be, I don't know, 7-8%. There you go, 10% down. So what I want to do is I want to just check out this company and see if it is actually basically a good company to add to our portfolio. One thing I've noticed the last couple of days is Seeking Alpha has now got something called Virtual Analyst Report, which is quite nice. And you've got basic information about the company. They tell you the valuation, the growth profile, profitability, the momentum, revision, and they give you a little bit of information about the company, which is quite nicely generated. And one of the things they talk about here is the fact that Applied Materials is well positioned in the semiconductor equipment market, driven by growth in high band memory, which is one of the products that they create, and DRAM, which is dynamic RAM, and advanced packaging technologies. The company's benefits from strategic growth initiatives, robust fundamentals, and a strong balance sheet, enhancing its long-term investment appeal, which is quite nice to see. But also, basically, some risks, of course, involved with this type of business will be the exposure to China, for example, situation. So that geopolitical risk is always there for the semiconductor companies, and we will see how that goes. So yeah, I thought that would be interesting thing to see. So what I'm going to do now is just quickly share with you guys what they've reported, and this is basically what they've reported. So EPS, basically it was a beat. When it comes to revenue side of it, was a beat. There was nothing in here that was alarming, to be honest with you. And I like the fact that the company generated 2.58 billion in cash from operations and distributed 1.77 billion to shareholders, basically probably buying back their own shares, as well as, of course, paying some dividends, which is quite nice. And the outlook for the company as basically applies expect its net revenue to be approximately 7.15 billion, which is basically slightly lower. Maybe that's the reason. Okay, Wall Street does not like this, so the consensus was 7.25. They basically said we'll probably get 7.15. Okay, so maybe they downplayed, or maybe not. We'll see whatever happens. And then when it comes to EPS, it's slightly different to what the consensus were. Actually, slightly higher, which is quite nice. Okay, so give or take, basically plus or minus 18 cents and so on. So we'll see what happens overall. But this is just, if you want to check that report, there's a lot of information included in the actual report. So it tells you what the company does, what some of the drivers are right now. You'll hear a lot about AI, okay, when you see this kind of thing. So the data center AI, edge AI, Internet of Things and robotics, EV and AV, renewable energies. AI is the biggest inflection of our life. You've got so much information, and a lot of it is driven by the AI boom. So this company should definitely be benefiting from that side of things. But what we now need to see is if moving forward, if this company is actually one that we can add to the portfolio in the long run, or not. Okay, you got the financial details here. You can see here basically the breakdown of their revenue year over year, basically where they are and so on. So there's a lot more information included here. You can see the three basically in comparison to this quarter last year, a year over year basically is up about 2% and so on. The gross margins, operating expenses and so on. So there, like I said, there's a lot of information in there that you can actually dig in. So what I'm going to do now is just look at give you some information about the company, financial side of things, and then we'll look at valuations, and then I'll tell you exactly what we're doing. Now, current price of the stock is based on $168 per share, EPS $8.90, almost 140 billion market cap. So it's a huge company. Wide economic moat right now 1.56, a little bit volatile if you think about it. Current PE is about almost a 19. The forward PE is about 19. So it's kind of where the 5-year average has been, which is interesting. When you look at the sector, we're looking at about 26. So it's way cheaper than currently the rest of the sector. Dividend yield, we've already seen 0.86. The payout ratio is 17%. The annual payout is $1.60. And the last 5 years, they grew that about almost 12%. There's six years of doing that. The dividend safety is A+, so that's the highest any company can get. Free cash flow right now, we're looking at about $6.56 billion. Free cash flow compound annual growth rate for the last 5 years, we're looking at about 17%. And free cash flow yield of over 4%, which is nice. Free cash flow margin of 28%, which is absolutely amazing. Profit margin, return on equity, operating margins, and return on equity, as well as return on invested capital, all of them absolutely amazing, which is really, really good. That's a solid, profitable business. That means the management are taking care of business, basically taking up the monies that we invested and so on, reinvesting in that to generate more money for the shareholders. And then of course we get the dividends, and we get the basically buybacks when it comes to shareholders, when it comes to the shares outstanding. Remember, if a company buys back their own shares, that means the one share that you own is now worth more. So the net income for the last 5 years is about 22%, which is really, really good. Total return the last 10 years, we're looking at about 24%. Now, there's not a lot of companies that do this, by the way, when it comes. In fact, maybe sometime we'll do some sort of a comparison with this type of business with another, so to see how much this is. 22% when it comes to net income, and the compound annual growth rate is absolutely huge. In terms of revenue side of things, in the compound annual growth rate for the last 5 years, we're looking at about almost 13%. The 27% when it comes to EPS, again, that's huge. 2.8 when it comes to the current ratio. So this basically current ratio helps us to understand if the company right now has enough assets to pay off the liabilities for the next 12 months. So they have a current liabilities. Is the current asset cover the current liabilities? If it's one or more, that means yes. Okay, so that basically covers it out, almost tripled. Okay, growth estimate for the next year when it comes to revenue side of it, we're looking at about 8%. EPS, we're looking at about 12%, which is absolutely decent. Now, if we go back here, just let's have a look at the expectations moving forward. So you can see 2024, okay, 2025 we're looking at about 11%, 2026 we're looking at about 13%. So double digits every single year when it comes to EPS, and revenue more or less the same. Okay, so this is what you will see. That 8% basically comes from here. Okay, that 8%. Okay, 2026. Okay, and current price, we've already seen $168 per share. The fair value from Morningstar is 193, which means basically it is not fairly valued. It should be undervalued. Let's just check quickly. In fact, yeah, this is still fairly valued. So $193 per share. It will become basically undervalued when it hits. I think it was getting closer to that, because right now we've got $167 per share. So yeah, fairly valued, according to Simply Wall Street, is about 14% undervalued right now, $216 per share. Basically, Tip Rank is saying their price target by the end of the year is $226 per share. That's about 34% upside. That's a moderate buy from them. $225 per share from Seeking Alpha, 33% upside from where we are. Basically, there's a buy from them as well. So we'll look at the valuations. I've also done 2 discounted cash flow models, so I'll share with you in a second. So 99% when it comes to the business activity side of things. When it comes to interest-bearing debt, is 4%, and the 5% when it comes to interest-bearing securities. And as you can see, they have been buying aggressively. Basically, they're buying back their own shares over the last 10 years, which is quite nice to see. Now, looking at the valuations, okay, so this is the company. We're looking at Morningstar valuation, which we have seen. Seeking Alpha, we have seen Simply Wall Street. And then we've got multiple valuation model that I used, which was quite high. And then dividend discounted model that we also used, which gave us $179 per share. If you add up basically if you average out all of that, you get $213 per share. Current stock price is 168. I promise you this 27%, of course, but I promise you this is probably the closest I would be looking at this company, or even maybe if it hits 180s, that basically that's probably my entry point. But as you can see, the currently is $168 per share. So the only thing that I will not be doing is probably be adding to this portfolio, and probably will be adding to the family portfolio. And the reason is because I do own other companies in this portfolio that are very similar sort of a kind of industry. So you got the Broadcoms, you got ASMLs, we got Qualcomm. So I do have quite a bit of that in represented here, but less of that in the family portfolio. So this one is definitely a good candidate for the family portfolio, and I will share that with you guys on the Discord and also as well as the Patreon account if I add it to, but it will not appear here. I don't think that will happen unless drastically things change and probably goes down even more. Then I will probably be adding to it. But if you even said, you know what, I need a bit of margin of safety, and you said, okay, maybe I need 15% on top of where it is right now, okay, that's about 180. There is still a buy for you. So yeah, that's the company that I wanted to share with you guys. As always, okay, all of these things you see here, whether it's the Morningstar, whatever, all of them are kind of using basically the past data to kind of predict what the company will do in the future. So again, that's a bit of estimation going on. So that's why you always have to have a good margin of safety before you buy any of these companies, before you add them to your portfolio. So be cautious, be basically careful with those kind of things. But yeah, final thing I want to show you guys is the compare this company, okay, with the S&P 500. And what I want to do is also compare it with the top boys here on that sector, as well as of course share it. I wanted the total return, not just the price return. And as we can see here, let's start with the 3 years, for example. And what you would see is basically 3 years is about only 10%, and the rest of them are kind of okayish. Okay, and then when we look at the 5 years, you will see 185 basically percent in comparison to S&P 500, which is only 88%. Basically, this one is slightly lower, this one is slightly higher. Of course, this one is slightly lower as well. Teradyne actually is not that great. I don't think it's done well over the last 5 to 10 years. But oh yeah, wow, 460, 600, 1000 over 1000, closer to 1000, 188, and then basically Applied Materials is about 85%, which is really good. So this basically gives us an idea of where the company has been. Potentially might do the same thing, it might not do for the next 10 years. So if you bought 10 years ago, right now you will be up over 800%, which is absolutely amazing. And that's the point that I'm trying to make here. I'm not saying basically it's going to do exactly the same, okay, because the past does not tell us what's going to happen in the future, but it kind of gives us an indication of where the company potentially might end up. Anyway, that's the company I wanted to share with you guys. If you're interested, of course, do your own research. Please don't just rely on what I'm giving you here. And if you can join us in the Discord and Patreon account, that would be absolutely helpful. Have a wonderful day. Assalamu Alaikum.